Mr. Anandaraman. He is a manager of BDS India LLP, and Ms. Samyukta ma'am from SATTRA team, co-founder and partner at SATTRA team. Both of them are going to explain to us about angel tax and how we can get the exemption as a early stage startups and what are the benefits from the startup side and investor side. I welcome you, ma'am. We can start the session. The session is yours.
Yeah, thank you so much. I thank Sathyabama for giving us this opportunity to discuss on angel taxation. As this has been rightly introduced for the upcoming, for the current financial year 23-24. I think this is the right topic, and with a lot of foreign investors coming into India now to invest in startups, and startups have also tremendously grown in the last few years. If we take the data and see there has been a significant growth in startups in India in the last few years. So I think this is the right topic and at the right time that we are discussing on angel taxation. In order to address the audience that we have here who are startups as well as who are investors, I think we have chosen selected areas of this section from Income Tax Act so that, it is easier and understandable for the audience here. In case you have any queries on this, please feel free to ask us during the session, or you can write us for the session. There wouldn't be any issue on that. I'll just share a small presentation on this. You're able to view my screen, right?
Yes, ma'am.
Yes. So first we will go with what is angel investment. What is angel investment, and so, like I had earlier about this. So, as you see, there are a lot of startups that are coming up in India now, and all these startups, they require some form of investment to kick off the business or for their working capital requirements. So, in order to seek this kind of an investment, correct? A lot of startups, they approach high net worth individuals or companies or a consortium of funding or investors, or a lot of other investors are being approached. So these investors are called as angel investors, and because they provide the early stage of investment, that is a seed investment that is required for these startups to kick off their business. And what is it that these startups provide in exchange for the investment that has been made by these companies or individuals? So the startups provided in the form of an equity, or it can be in the form of a convertible preference share, or in debentures. We will not get into the topic of debentures today or debt instrument today. We will just cover equity, which is the most known form of stake in a company. I'm sure all of you are aware that once you incorporate a private limited company, you have I'm just going into a few seconds of the basics. You incorporate a company, a private limited company. You have directors, you have shareholders. Shareholders hold equity in the company. So there is a share capital that you initially incorporate your company with. But however, in order to take the company forward and in order to initiate your operations, kick off the operations, you will require additional investments. And these additional investments are, these additional investments can be got from these investors, from these angel investors, in exchange for you giving them a form of stake in the company, which can be an equity share or which can be compulsory convertible preference share. Again, there are debentures that are being issued as well. However, as of now, we are not covering this topic, but you can raise your queries on this once we finish this topic. Yeah. So, why did this angel taxation? Why is this topic being discussed now? Why is it that this has become a talk of the startups now? What? So we'll go into a little bit of background on this topic. Okay. So, as you're all aware, when you go in for funding, when you go in for a third party investment in your company, a third party stake being invested in your company, what generally happens is that you will have to value your company. A valuation has to be carried out. Based on the valuation, you will be approaching these high net worth individuals or foreign investors, or you will also be approaching companies or a consortium of funds for them to invest in your company. So what was happening is that there is something, when you value your company, correct? And when you arrive at a value for that company, so we will ask the investors to invest so much of fund into the company based on the valuation, correct? And in exchange, you'll be giving them shares. A share has two components to it: the face value and the share premium. So face value is generally fixed at the time of incorporation, which is in general, I'm talking in general, which can be a 10 rupee or a 1 rupee face value of the shares. And there is something called as a share premium, your securities premium, which is nothing but it is over and face value of shares is called as your securities premium. So what was happening? Companies did valuation for their companies, and one startup did their valuation. They approached these angel investors to invest in their companies. The issue of shares, that is the for the investment, the exchange that was given was the shares. That issue was shares were done at an exorbitant price. That is the price that is more than the fair value, the price that is more than the valuation. That was how these shares were issued to these angel investors. Now, what happens? What was happening was, in order to avoid, shares being issued at an exorbitant price, some unaccounted money that is coming via these exorbitant price into the company and being subscribed as shares in these closely held companies. The government, the Income Tax Finance Act had come up with a section called the Section 5627B. So what Section 5627B was talking about was, when shares are being issued at such exorbitant price, initially before this amendment had come, before the Finance Act 2012 had come in, when shares are being issued at an exorbitant price, that is more than the merchant banker valuation, more than the valuation, what was happening? This was called as a capital receipt, and this was not being subject to tax. And this was being used by many of the resident investors and many of the non-resident investors. They had used this as a tool to bring in the unaccounted money through subscription of shares in these companies. And so the government had noticed, that this had led to a lot of tax avoidance. So in order to curb this practice, Section 5627B was inserted in Finance Act 2012. This was mainly to avoid the consideration which was paid to the closely held companies by the investors, non-resident, more than the fair valuation of these companies. Now, this is a very simple, a very simple explanation giving, on when this is applicable, on what case these are angel taxation is even applicable. Closely held companies are there. Now, like I said, you issue shares at a premium. Okay. When you issue shares, you will have resident investors, you will have non-resident investors. So for resident investors, this was already applicable when the Finance Act 2012 had come in. Okay. But however, For non-resident investors, where recently there has been non-resident investors has been growing in India. There are a lot of NRIs who are investing in India, who are investing in the startups in India, more for investing in startups in India. Correct. Earlier, before these were not subject to tax, they were able to issue, or they were able to, subscribe to issue at an exorbitant price, and they were not subject to angel taxation up to 31/3/2023. That is up to for the financial year up to financial year 2023. This section was not applicable at all to non-resident investors. However, in the recent past, since there had been an exorbitant increase in the non-resident investor in the startup community, this section has been made applicable from financial year 23/24, that is from 1/4/2023. Correct? This has been made applicable. So any shares that are being issued at a premium, angel taxation, the section of angel taxation is applicable. So the main thing that we have to look at this is for the NRIs, that's for the non-resident investors who are coming in from the financial year 23/24. Again, up to financial year 22/23, there is a 2023 is not applicable to NRIs. This is applicable to resident investors only. Okay, now coming, coming into the how the angel taxation, how is the value identified, how is the tax calculated? Again, a very brief one. Like I said, angel investors are investors who invest in these closely held companies. They invested at a premium. Now, what is this premium, and how do they determine whether the price that has been fixed and the amount that has been invested is exceeding the required limits? Now, let's say there is a fair market value that has been determined. Correct? How is the fair market value determined? In the next slides, you will be able to view that. But what is the price that has been fixed based on a fair market value, which we call as FMV? And when we issue a share more than the fair market value, more than the price that is determined based on a valuation, then angel taxation is angel taxation gets kicked in. In case the share price is issued at less than the fair market value that has been determined by the merchant banker valuation, or that has been determined based on the formula that has been given in this section, then if it is at the fair market value or less than the fair market value, then there is no taxation is applicable. So in general, anything that is issued more than the fair market value, then angel taxation section kicks in. If it is less than the fair market value that's determined by the merchant banker valuation, or at the fair market value that's determined by the merchant banker valuation, angel taxation does not get kicked. So, what is fair market value? This is the most important section, and this is the most important area that is required to be understood here. So there are different methods that are being done by Income Tax Act on how to arrive at a fair market value. Okay, the fair market value again is being divided for resident investors and non-resident investors. And I think resident investor fair market value has been in existence for quite some time now, and there has been much of issues there. So every fair market value has based on these methods only you can determine the fair market value, and fair market value will be determined by a merchant banker. Okay, I'm sure all of you are aware who's a merchant banker. So it has to be prepared and certified by a merchant banker, and except the method which is quoted as a net value method, because it's directly based on the books of accounts. So that would not be required to be certified by merchant banker valuation. But other than that, every other method, discounted cash flow, discounted cash flow, comparable company, or property, the other methods that are being given here have to be have been determined by the merchant bank. Okay. So what issues that are surrounding this fair market value, and how do they determine fair market value? What happens if fair market value being determined? What are the issues that are in the past? What is it that can be done? So going for, for this, I will ask my colleague, Mr. Raman, who's also a tax expert. He is a manager of taxation from BDO India LLP. I would like to throw some light on this topic.
Thank you, Samyukta. And I request you to keep the screen shared so that it would be easy for us to migrate to the PPT. And if you could just quickly move on to the earlier slide for a minute. Yeah. So, good morning to one and all here. And I am Anantaraman from video. And thanking Sathyabama for giving us this opportunity to actually share our thoughts on this recently amended provision of angel taxation. Now, there are two methods which Samyukta had already told, which applies to resident investors. Now, these two methods, technically, if you see the first being net asset value method. So, what is this net asset method? It is nothing but the net worth of the company that gets computed basis the balance sheet that is available for the company, and that gets divided by the number of shares that are there as part of the company's share capital. That gives the net asset value. So this is how it is generally computed. It's a plain vanilla method which is generally utilized by any sort of company in terms of valuation. Now, this discount free cash flow method, there is a projection that is being laid out, and the growth in revenue, growth in expense, growth in profit is being projected to find out what is the free cash flow available over a period of time, based on which the value of share gets determined. Now, this initially, when the law came into force, was allowed to be certified by chartered accountant or a registered valuer, which subsequently the law got amended to be done only through a merchant banker. Now, as Samyukta had pointed out, before 1/4/2023, the provisions of angel taxation was restricted to the resident investors. So, if a non-resident investor, okay, if anybody's got questions, please do raise it and address it once the presentation is done. But you could please use the chat box to raise your queries that will be addressed at the end of the session. Now, with respect to the non-resident investors, they decided that the benchmarking is not going to be in line with the normal resident investor. So they decided to add in 5 additional methods over and above the existing 2 methods. The first method and the second method for non-resident investor is verbatim the same as what you've seen for a resident investor. So in case of non-resident investor, in the slide that you have in front of you, starting from discounted free cash flow to the replacement cost method, every method requires the blessing of a merchant banker. Now, this is a category 1 merchant banker whose valuation is being sought. Now, when we come to comparable company multiple method, does it apply to a resident investor? No. If it applies to a non-resident investor, how do we use this method? Now, this method is left at the disposal of the merchant banker who does the valuation. So, how do we go about this method? Generally, what a merchant banker would do is identify a similar company corresponding to the same industry, and whatever is the price multiple that corresponds to that company would be applied in identifying the cost of the company which is seeking non-resident investment. Now, the next method being probability weighted expected return method. The security is considered to have various types of returns, that is fixed returns or returns, negative returns or positive returns, or returns after a specified point of time. So various outcomes are determined. If it is going to give me a return in the next year, if it is going to give me a return after 5 years, if it is going to be repurchased by the company after 7 years. So there are various outcomes that are predicted. Based on these outcome, valuation is carried out, and that valuation is given towards the value of the equity capital. Now, in this case, a more wider scope is considered to arrive at a better valuation option for non-residents. Now, the next one being option pricing method. This is a very famous method by name Black-Scholes. which is generally used for option pricing. And it is understood that there is always an option with the shareholder to either procure the share or refrain from procuring the share. Now, when it comes to the option of procuring the share, he might procure it immediately or he might wait and procure it. So there is an option cost and an instrument cost. Both clubbed together would generally determine the option pricing method valuation of shares. Now, the milestone analysis method, generally where the company does not have much of a precedence to it, or the history surrounding the company is very minimal, then what the company would do is it would wait for certain milestones to be attained. For example, doubling up on revenue, or probably controlling on costs, increase in profitability. Certain other milestones will generally be identified to see how the pricing of the share needs to be carried out. The last method being replacement cost method, it applies in understanding what would be the cost in re-establishing the business from scratch. So if I am able to identify the cost that would require for me to re-establish the entire business, that constitutes the replacement cost. So these 5 methods are brought in to understand how the valuation can be chosen for the purpose of non-resident investment over and above the existing 2 methods. Now, is there any mandate that only one of these methods needs to be followed? No. Who chooses which is the most optimal method? The company issuing the shares is going to choose. So the startup in our case has a choice to go ahead with any of these 7 valuation if it goes for the non-resident investor input. Now, if it goes for resident investor input, companies will generally, especially startups, will not go for the net asset value method. Why is it so? Because startup is one place where it is not the asset of the business that talks about its existence. It is the idea that is getting conceived and gets life into when the business starts working out. So it is the idea that is getting valued. Therefore, for startups, generally the discounted free cash flow method gets utilized. Samyukta, to the next slide, sorry. Samyukta, sorry, next slide. Okay, thank you. So now, as I had told you before, these are methods prescribed by the income tax department, or the finance ministry had blessed these methods. Now, just because there is a method available in place, it does not mean that it is free from litigations, which means even though there is a method that has been blessed by the department, if I go around projecting vague numbers or unrealistic numbers, which gets into the share price valuation, it still opens itself to the ambit of litigations. So now, as long as I'm able to justify the tax officer stating that I have used projections for the purpose of valuation, it can be rooted out from the purpose of valuation under this particular. So let's take a couple of cases which actually had come up with startups where the issue was, generally, as I have told you, startups will always rely on the discounted cash flow method when they issue to resident investors. The reason being, assets will not be their stronghold. It is the idea which is going to create assets, which is the stronghold of startups. But what would the income tax officer do? Because for him, the goal is to only offer more income into tax. What he generally does is that he denies acceptance of discounted cash flow method and he goes with the net asset method. Now the taxpayer is burdened with the tax outflow. See, the very idea of this angel investment is to provide cash flow to startups which have ideas but do not have financial funding for carrying out the same. This very financial funding gets burdened by these angel tax. Therefore, the investor getting stuck, a company which gets stuck because of this kind of a rigid interpretation of law, they had gone on and appeal with the income tax authorities, namely the tribunal. Every single judgment where the company was able to prove there was a valid investment behind this particular project, and the income tax officer was unable to prove that the projections were wrong, was always decided in favor of the taxpayer. If the income tax officer cannot prove that your income projections are wrong, and if the income tax officer cannot prove that there is an invalid shareholder who has actually gone ahead with the investment, there is never going to be an issue of angel taxation. Now, if I know that market value is going to be 100 rupees, and if I issue it at 120 rupees, then angel tax provision will apply. So for 20 rupees, the income tax department will tell that you have claimed 20 rupees more than what you're supposed to claim, and that 20 is an income to the income tax department on which I'll have to pay tax. But if the company is not able to substantiate as to who the investor is or what is the source of income of that particular investor, then the company will not only get restricted by means of this 5627B, which Samyukta had spoken about, the angel tax, but it also opens its bracket to this section 68, which talks about unexplained cash credit. So when section 68 gets attracted, there's one additional risk that we suffer, which is a higher rate of tax that applies. Therefore, this section nowadays doesn't find place because the valuation methodologies have made it very clear on identifying the apt investor and getting the right source of investment. But still, this does not rule out this risk that we still carry as a startup. So the judgments that have been given here is only to make us understand that there is no mandate to follow only one method. These methods are given at the option of the company which is seeking to issue shares. Yeah, so if you could mute, if others could go on mute, it would be helpful. Yes. So the judgments have primarily focused on stating that option is always given to the taxpayer. If the taxpayer is able to prove that he has chosen a particular option and he has given valid details for computation of share prices, and also prove that there are genuine bona fide shareholders who have actually subscribed to the capital, there is never going to be any sort of angel tax implication, provided that we comply with various conditions that have been listed down so far. Yes, Samyukta, please to the next slide. Now, so let us try to understand the valuation when it is put into play. But before that, one quick point. With FY 23-24, that is the Finance Act 2023, brought in one additional relief to these startups. What did it tell was that if you identify a particular valuation, let us say, for instance, there is one startup which has gone for a discounted cash flow method valuation by a merchant banker, and the merchant banker has come out with a report telling that 1,200 rupees per share is the value. Now, up to financial year 22-23, if you issue shares at 1,210, you would be taxed for the 10 rupees. But the Finance Act 2023 brought in one more amendment by name of Safe Harbor. What is the Safe Harbor? Fair market value into 110%. Fair market value into 110% was accepted as admissible threshold. It was accepted as admissible threshold. So let me give you an example. So if 1,200 is the valuation that my merchant banker gives me, if I am going to charge up to 1,320 from my shareholder, I will not be covered under angel tax. So this was a beneficial amendment that was brought in. So I will repeat. So whatever is the fair market value that is determined by the merchant banker, I am not going on the net asset method because we are talking about startups where, as I had already initially told you, that the ideas gain value here and not the assets. Therefore, the discounted cash flow method is the most preferred method. And if I'm going to issue it at 110% of the value that was being valued at, I will still not be covered under angel tax provision. So just because my merchant banker says 1,200, if I issue it at 1,300, I will not be covered. So that is discussed in case A here. So Mr. A, resident Indian, subscribed 100 shares of XYZ Private Limited at 1750. So that is the issue price. So A has paid 1750 for each and every share he is procured. Now, the fair market value of the shares of the company as per merchant banker was 1600. Now, if you look at the same situation before FY 23-24, 150 rupees per share multiplied by 100 shares would be taxed as angel tax. But this year, what happens? Suppose this issue happens during the current year. What would be the outcome? Though the issue price exceeds the fair market value, it is within the safe harbor of 10%. How do we find out 10%? Fair market value is 1600. 10% of that is 160. Therefore, 1760 rupees is the admissible price. I can price up to 1760 and angel tax implication would not arise. Now, let us move on to the second case. As I had told you that there was one amendment which brought about the safe harbor. One more amendment came into play, which was the validity of a report received from a merchant banker. Initially, there was no such hard and fast rule on validity of the report of a merchant banker. Now it comes with a ticking timeline of 90 days. You have only 90 days up to which the report remains valid. So let us go to the second case. Miss K, a non-resident, subscribed to 500 shares of A Private Limited at 1850 on 10/2/2024. And merchant banker valuation for the same was received at 1800 rupees on 1st October 2023. Now, if you look at it, banker valuation was received on 1st of October. So, and the transaction where the subscription to share has happened on February, so which is beyond 90 days. So what would happen in this case? You cannot proceed with this. You will require a fresh valuation. Otherwise, angel tax implication will arise. Is it clear? So if you use the report within 90 days, issuance of any sort of shares, you are under the umbrella of that particular valuation. But the moment you cross 90 days, unless you have a valuation, you are exposing yourself to the angel tax implication. So what will happen? Suppose I forget to get a valuation, what will happen? The only other option left would be to use net asset value method, which would result in a huge angel tax outflow. Submit that to the next slide, please. Okay. So now that we've been looking at the harsher side of things in terms of taxation and the exposure, let us move on to the more convenient side, or probably the comfortable side of exemptions, which was also the talking point of this particular session. It is not that angel taxation has always been exposed to the ambit of taxation without any exemptions. Exemptions have always been there. Especially when the Prime Minister in his 2015 speech was talking about motivating startups, he decided that startups should not be exposed to this harsh environment of taxation. And therefore, there were a couple of exemptions that were given from this angel tax application. Now, what are the cases where exemptions are going to be applicable? Now, if it is going to be a venture capital fund that is making an investment, or if it is going to be a SEBI registered alternate investment fund that is making any sort of investment into startups, they will not be subjecting the startups to 56(2)(7)(b). So point one, if it is a SEBI registered alternate investment fund, AIF, or if it is a venture capital company or a venture capital fund which invests into the company, then no matter what be the price the company charges to these investors, company will never be subject to angel tax. So fair market value as per your merchant banker is 1000. You issue it to SEBI registered AIF for 5000, no angel tax. So that is how the exemption has been worded. Now, there is another point which talks about eligible startups, and these eligible startups needs to be registered with DPIIT. I'll come to that in a while. Let us not go into the eligible startups because that is a separate point of discussion. So and it's colored in green to indicate that there is an amendment in that provision for the current year. Now, the third point, namely, non-residents were brought into the ambit of your angel tax in the current year. Up to last year, whatever funding was received from non-resident would never be questioned. It was outside the ambit of angel tax, but this year it is now brought into the ambit of angel tax. But from a FEMA standpoint, from a foreign exchange management standpoint, FDI is expected in certain sectors to strengthen the country. Therefore, there have been some relaxations with respect to the exemptions for non-resident entities. Now, the exemption was specific. First of all, the exemption were extended only to 21 countries. 21 countries, and not anyone from these 21 countries could avail this exemption. They notified who was eligible for exemption and that who should come from what country. So this is what the exemption is trying to talk about. So when I talk about who is eligible for exemption, government or government agencies with government ownership exceeding 75%. So if there is going to be government agencies, 75% of the participation should come from the government. That was the first kind of person eligible to enjoy this exemption. Second one was with respect to insurance companies. So insurance companies, banking companies were also provided this particular exemption where they could go ahead and invest abroad without being exposed to angel taxation. Third one being foreign portfolio investors, pension funds, and broad-based funds where more than 50 investors, not more than 50, sorry, more than 50 investors being not a hedge funding employing diverse or complex trading strategies. So there has to be more than 50 investors and it should not be a hedge fund. And then it should employ diverse or complex trading strategies. Now, these three were the eligible non-resident entities. And what are the 21 countries that is listed down here as Australia, Austria, Belgium, Canada, Czech Republic, Denmark, Finland, France, Germany, Iceland, Israel, Italy, Japan, Korea, New Zealand, Norway, Russia, Spain, Sweden, UK, and USA. But surprisingly, countries such as Singapore, and then countries such as Cayman Islands, British Virgin Islands, and Mauritius have been consciously kept away because these are the countries from which maximum FDI funding comes in, which needs to be monitored. Therefore, the government has consciously kept these countries outside the ambit. So, let me give you an example. Suppose I receive funding from Cayman Islands. Please tell me.
Sorry, sir. Just now he joined.
Sorry.
Sir, just now he joined. That's why it's a problem. You can continue, sir.
Okay. So now, so for example, if there is going to be a funding from a government agency out of UAE, so UAE has a government agency which is funding into a startup, that startup will not enjoy this exemption because it is neither a notified entity, though it is a notified entity, it does not come from a notified country. So that is how this needs to be understood. So if you want an exempt foreign investment, it needs to come out from a notified non-resident entity from a notified country. Otherwise, you would lose that exemption and you will be exposed to angel taxation. Okay, so that was the next amendment. Samyukta, to the next slide, please. Okay, so now this eligible startup, what is an eligible startup? So an eligible startup should be working towards innovation, development or improvement of products, processes, services, scalable business model with high employment potential and wealth creation. So this should be something new. This should be something which makes an additional improvement to the existing, and it should have employment creation abilities, and it should also have wealth creation probabilities. So these, when they are clubbed together, they are considered as an eligible startup, and your turnover cannot be more than 100 crores. So your turnover restriction should be 100 crores, which generally is going to happen in case of turnover startups, because you don't end up being a startup with more than 100 crores initially itself, except for exceptional scenarios. Generally, it would fall within this ambit. Now, what is the type of entity or form of entity eligible for this eligible startup exemption? It could be a closely held company, CHC. It can be a partnership firm. It can be a limited liability partnership. Any of this will be eligible for this eligible startup definition. What is the time span? It should be within 10 years from the date of incorporation. So within 10 years, you are eligible to be classified as eligible startup. Now, if you cross 10 years or if you cross this 10 years threshold, you will not be eligible to get yourself under this eligible startup umbrella. Now, when will it become eligible startup? You will have to register yourself with DPIIT. Now, this registration with DPIIT comes in Form 2, which needs to be done provided your conditions that have been specified in points 1, 2, and 3 are satisfied. You will be eligible to classify yourself as an eligible startup. There is one more condition. The condition that comes after this is that after I make an investment to a resident, share capital plus share premium cannot go beyond 25 crores. That was the condition that existed up to 31 March 2023. What was the condition? Share premium plus share capital after the issue cannot exceed 25 crores. Now, once the finance minister had given out her speech in the budget specifying that this angel tax implication was going to extend to non-resident investor as well, the question was that whether this DPIIT exemption would apply to non-resident investors as well, because the entire ambit of angel tax applied only to residents erstwhile, and non-residents were kept outside angel tax. Now that non-residents were brought into the purview of angel tax, will they also be eligible for this exemption? Became a question. So for this, the Central Board of Direct Taxes came out with a notification. They told that yes, non-residents will also enjoy this exemption benefit. So if a startup is recognized by DPIIT, then whatever be the contribution that is being made by a non-resident to that startup will not be covered under angel tax. Now there are two questions possible. Suppose I am a non-resident and I also put money. Resident also puts money. Now you told that 25 crores is the threshold. Will it apply for non-resident funding as well? No. That is where one more benefit was granted. So let me give you an example to make you understand this point. I have gone for issue of shares to a resident, and after the issue, my share capital plus share premium is 24 crores. Share capital plus share premium is 24 crores. I have gone for one more round of funding, and this time I am giving it to a non-resident, and I am raising 20 crores. Now the question is, am I not failing the second condition here? No, we are not, because though the exemption limit was extended to a non-resident, they specified that this 25 crores computation mechanism will not change. What was the mechanism to raise this computation? Share capital plus share premium of a resident equals to 25 crores. Now, when a non-resident puts money, this 25 crores will never even be applicable for that. Therefore, non-residents are given one additional benefit by this particular provision. So, I'll give you one more example to elucidate this point. That is a startup with 2 crores of capital. Now they are going for a resident share issue. Okay. And when they issue shares, they are able to raise share capital plus share premium to 25 crores. Exactly 25. Okay. Let us keep it as 24 crores. So they are getting 24 crores now. 2 crores was what they had. And after issuing share capital, they have raised 24 crores. From 2, it has become 24. Not by 24, it is 2 to 24. Now, when they go for additional funding, they have to check whether this additional funding will disturb the equation of 25 crores. Unless there is a doubt, I request others to mute, please. So this 25 crores, and I am going to ask the non-resident to pump in. When the non-resident pumps in 20 crores, for example, how will I compute 25? 25 will be computed as share capital plus share premium from a resident. So I will restrict it with the resident. Therefore, I might have 44 crores, but I will still be compliant with this, and the exemption will very much be applicable. I hope that particular example made it clear. Samyukta, to the next slide, please. Okay. Yes. However, Samyukta, just the earlier slide, sorry. Oh, yeah. So there is one more benefit that was extended. Now, this benefit is known as price matching option or probably benchmarking option. And what exactly is the price matching or benchmarking option? Let us take an example. There is one startup. The startup has raised funding from an AIF, and it has also raised funding from a non-resident who is situated in a specified country, and that non-resident is a specified territory. So we have already seen 21 countries, and we have also already seen the eligible entities. Now these two, I have raised when my fair market value is 1,000 for both the cases, I have raised it at 4,000 rupees. Okay. Now, this provision has made an amendment in such a way that whatever is the funding that was already raised by the exemption route, plus the funding that I am going to raise by the non-exempted route, find out the total. So for example, AIF funding plus non-resident funding together is 4,000 crores. Now, if I am going to use the same price, whatever price I have issued for these two entities, if I am using the same price and raising up to 50% of the exempt funding, then I will not be covered under angel tax. This is one additional breather that has come from the finance ministry. So let me take you through the example and then come to the provision to make it much more easier. So funds raised from AIF 1 crore at an FMV of 2,000 rupees, issue price was 2,500. Now, forget AIF, what would we generally assume? Since the issue price is more than the FMV, we are going to go ahead with angel tax implication. But since it is AIF, it is exempted. Now, and funds raised by FPI. FPI is an eligible non-resident in UK. UK is a country which is notified. And when my FMV was 2,000, I have raised 2,500 as the issue price. So how much have I raised? 1 crore plus 2 crores, 3 crores I have raised from exempted institutions. Now, raising additional 1.5 crores at an issue price of 2,500 from other non-resident investors. Now, these non-resident investors are taxable. So, for example, high net worth individual from US and UK pump in 1.5 crores. What would happen? The question is whether it is taxable or not. Yes, it is taxable. But here, because of an exemption that was granted by means of a price matching option, we are not going to get taxed. How will we not get taxed? The exempt funding is 1 crore plus 2 crores. Taxable funding is 1.5 crores. Now the total funding is 1 plus 2, 3 plus 1.5, 4.5 crores. So 1.5, that is the taxable funding divided by the total funding should be less than 50%. Taxable funding is 1.5, total funding is 4.5. If I divide by it, it is only 1/3, 33.33%. Therefore, I can raise this 1.5 crores with the same issue price utilized. If I had done the same exercise 1 year before, it would be taxed because this price match option was not available earlier. But now this option is being made available. It makes life easier for us. But that 10% threshold which we had seen earlier will not be applicable in this case. If a startup uses this price matching option, then this 10% safe harbor will not be applicable. One more condition is that I have to get this money within 90 days from the date before or after the date when the shares from the exempted units were being received. So there has to be a 90-day gap within which the funding for the taxable portion needs to be received. Yes, Samyukta. Next slide. Okay, so now, are there any restrictions? Because there was a GSR 127 notification which came during the 2019, which gave the conditions for an eligible startup, which we've already seen as less than 10 years from the date of incorporation, 100 crores of turnover, processing of ideas and creating wealth and employment being the conditions were given by this particular GSR notification. The said notification also gives certain restrictions. What were the restrictions? The company should not become a subsidiary of any other company. The startup cannot become a subsidiary of any company, which means what? More than 50% of capital of the startup cannot be held by the same investor, whoever be the type, whatever be the type of investor. Company, especially because being a parent company, it cannot become a subsidiary, meaning no company can hold more than 50% of capital of any startup. Then they will lose this exemption of an eligible startup. Now, and what is the time span of prohibition? 7 years from the end of the financial year in which shares at premium are issued. So, for example, June 2019, if the startup is going to issue, let us say, shares at premium. Now, end of 2019 will be March 2020. So 7 years from March 2020, they cannot become the subsidiary of the company. And that alone is not the restriction. There are additional restrictions in the form of certain assets, okay, or procurement of certain assets. What are they? So capital contribution. The startup cannot contribute capital into any other entity. They cannot grant loans or advances to any other entity, or probably invest in costly motor vehicles and procure shares of any other company, or probably ventures or preference shares of any other company, or land and building of any other concern, or probably any other land and building for that matter. Now, if this restriction is suppose a partner does not comply in these cases, what would happen? The angel tax which was exempted will retrospectively get taxed. What is the meaning of retrospective? Whenever you, whichever year in which, in our example, 2019 itself, the angel tax will get taxed. Okay, the next slide, Samyukta. Okay. To conclude, what are we looking for as a startup? What should be our core concern? First of all, when we know that there is going to be numerous options towards valuation, especially for non-resident investments, identifying the best alternative will be very, very important. And especially for a resident investment, we generally would not have any other option but for the discounted cash flow. But when it goes to non-resident, identifying the best possible option, which will have proper data backup along with the valid point of determining the price, which would determine the best alternative option. But the point is, what is the best method? Whichever method is going to give me the maximum cushion in terms of share premium. So if suppose there are 7 methods and 3 methods give me 300 rupees premium, and the remaining 2 methods or the additional methods of 5, out of which 3 give me 300 rupees worth of premium, one gives me 350 worth of premium, and the last one gives me 600 worth of premium, then I choose the last one because maximum funding extraction can be done with that method. In case there is going to be a startup which has been in existence for more than a couple of years, so there is still a benefit of 10 years, even if in case of DPIIT. Let's exclude the fact that a startup has not registered under DPIIT. Can they have any other beneficial options? Suppose the startup has been in existence for 5 or 6 years and there are some AIF funding that has come in, or probably specified non-residents from specified countries have funded with a specific price. This company can utilize this option to use the price matching option, which was discussed some time back, where the exempt pricing can be used as a base for the purpose of new funding from a taxable person. Now, all said and done, if I am going to take shelter under the DPIIT recognition, it is very important that I comply with the conditions and restrictions to avoid angel tax implication. Now, when you start, immediately you don't see funding from NR investments from specified type of associates. But in the due course, once the idea seems to be a successful one, generally the funding from non-resident specified entities will also start pouring in. Now, the next interesting issue that generally comes up is what happens when there is a rights issue and bonus issue. Taking up the easier alternative, bonus issue is nothing but capitalization of profits. So whatever reserves you have, it gets converted into capital. never ever the question of angel tax will come into play. Now, what about rights issue? Rights issue is going to be additional funds infusion from the existing shareholders. Does angel tax apply? Yes. So when I give shares to the existing shareholders, I'll have to be extra cautious to check that once again the fair market value is determined as per the provisions of law, and I make a price issue which is within this fair market value threshold. Now, one interesting aspect is with what Samyukta initially started off telling about other types of investments, namely the preference capital, etc. Whatever we have seen so far as the options available would apply to an equity share and a convertible preference shares, that is compulsorily convertible preference shares. So does angel tax apply for compulsory convertible preference shares? Yes. But if I am going to issue compulsory convertible debentures, will it apply? At the time of issue of debentures, it might not apply. But when I convert these debentures into shares, then angel tax implications will arise. So that has to be kept in mind when we go ahead with the CCD issue at the point of issue of debenture itself. Now, there is one headache that generally come across, maybe on account of different types of valuation. For example, if I am to go ahead with Companies Act mode of valuation for preferential allotment, generally it would request for a registered valuer who needs to value it for the purpose of preferential allotment. Now, in case of income tax, initially it was accounted, now modified into much category 1 and that not funding involved and valuation requirement, FEMA calls for semi-registered merchant banker. Now, if I am going to have 3 different valuations done, it becomes a very costly exercise for startups. Therefore, what would be the best option in this case? Probably identifying registered merchant banker who is also a registered valuer, which is still available in the market as we speak, as an option, so that one report would serve multiple purposes. This would be the right option to be chosen where there are multiple valuations that are required. Now, on a lighter note, probably gift city would also be explored as a tax saving option because the angel tax provision does not apply to startups which are there as part of gift city and receive feeder funds as part of gift city. So by and large, this is the entire set of provision with respect to angel tax. And you can move on to the previous screen, Samyukta. Sorry. So that would be the entirety of angel tax in terms of what are the applicable provisions and what are the exemptions that are being there as we speak today. So with that said and done, I'll open the floor for questions with people who've already raised it. Okay.
Yes, sir. It's a wonderful presentation both for Samyukta ma'am and Anantaraman sir. We have already collected some questions from the startup side. I will ask the questions one by one, sir.
Okay,
the
one
first
minute.
question
Is this the screen where I see some questions? Are they the questions you're going to read out, or is there something else?
No, sir. So we have collected in different questions, because you covered the answers in the end of the slide. A lot of answers you covered in the presentation already.
Oh, okay.
Okay, sir. Sir, if there isn't any tax exemption claim, how many times we can claim angel tax exemption? Is there any limit? Because if a startup is raising for the first round, first round, the seed round is angel investment, they can claim the exemption. Okay. After that, they will raise the follow-on rounding from the same investor or different investor. How many times? Is there any limit to claim for the exemptions?
Okay, so now answering your question, that depends upon the nature of investment that you're receiving. For example, you receive investment from a non-resident, specified non-resident from a specified country, there is no question of taxation that is going to arise irrespective of how many ever times you raise it. Or if you are a startup here, receiving funding from a venture capital fund, or for that matter from, let us say, your AIF. Okay, so category 1 AIF that you're going to receive, that will also not be subject to tax irrespective of the number of times you're going to receive funding. Now, Alternatively, if you're going to go ahead with what is known as your DPIIT registration, you have a restriction with respect to the capital plus premium. If your capital plus premium exceeds 25 crores, your resident investors cannot fund in anymore. In case they fund in, then that would result in taxability. But as I had already highlighted, this would not affect the non-resident investment. So ideally, what could be opted for is that once you receive share capital plus premium at 25 crores, restrict funding from your so-called resident investors, gain funding from non-resident investors, so that you would neither be exposed to angel tax nor have the restriction of funding.
Okay. Other than that, is this exemption is applicable based on the fund round or based on the investors' investment? Because if we are raising a round of seed round, means there will be 5 to 6 investors will invest in our company. Okay. If that investment round is around 15 crores, a single investor investing only 3 crores to 4 crores in the company, how will this angel tax be applicable for the whole round or for the single investor?
No, the applicability of angel tax is going to be based on the differential between the price at which you issue and the fair market value. Now, as long as you stick on to this threshold, so let us say your fair market value is 800 rupees. If you issue within this 800 rupees, angel tax will never be a concern. No matter whether it is the first round of funding or if it is the 6th round of funding or the 4th round of funding. But that is one additional burden though. What is that? Let us say, for example, my fair market value is 1000 rupees. If I issue it at 990 rupees, angel tax will not apply because we are within the fair market value. But for the investor, there is one more kind of taxation known as the gift taxation, which comes under section 56, because this is considered as a consideration which is less than the fair market value. Therefore, the differential will be taxed in the hands of investors. So what happens? 990 is the issue price, 1000 is going to be the fair market value. 10 rupees will be considered as gift received by the investor, and 10 rupees into number of shares will be the income in the hand of investor, which will be taxed in the hands of investor.
Okay. We are seeing some of the ideation stage startups are raise fundings, okay, from the investors. They mostly have the paid up capital and authorized capital of 1 lakh, but they're raising 25 to 30 lakhs as their investment. Is this also applicable for the angel tax? Because they don't have any valuation asset within their company. They only have the idea. With the idea, they're raising the fund. How will it treat as in the taxation regime, sir?
Okay. So when I talk about startups, it is a well-established norm that startups will not be having sufficient assets in their balance sheet, or probably the net asset will not be sufficient enough to cover funding from any sort of investor. That is why the basic ideology or the underlying premises based on which funding is received is the strength of the idea. Now, if the merchant banker is able to conceptualize the idea and build a case around it, telling that yes, this idea has a valid cash flow generating ability and it also has a proper market which would result in ideal growth in the real time basis, then you can actually have a valuation done. And if you are able to substantiate your case, no, just because I have an idea, I can't tell that I'm going to make it into a 1,000 crore company in 5 years, which does not make sense. But if I am able to prove that idea is consistently going to grow, and there is an active market which has not yet been tapped by competitors, then I will very much be able to survive with the valuation. Now that the valuation is received, it is only a matter of raising capital. Whether it is 25 lakhs, 25 crores, does not matter. As long as my investor is ready to fund in and I have kept myself in line with the valuation norms, there should not be any restrictions on funding.
Okay. There is another term called crowdfunding. That is not used for the startups because crowdfunding is mostly used for the social causes in India. But there is another option for the startups also. They can raise initial stage of funding through the crowdfunding method. Okay. Is there any applicable laws which is inside India? We can go for the crowdfunding and we have to provide any taxation for that crowdfunding.
Okay, Samyukta, you want to take it up?
Yeah. So crowdfunding, yeah, like you had said, there are cases here. I think in recently few cases where we had seen crowdfunding coming up. It's not very common. But when it comes to crowdfunding, I'm sure the crowdfunding happens at the incorporation level itself. Is that what you're referring to? During the incorporation of the company itself, the crowdfunding happens. Is that what you're referring to?
Yes.
See, at the incorporation level, this does not arise. Incorporation level crowdfunding, this does not arise because this angel taxation itself applies only when, like you had asked the question at the first round of funding, when the second round of funding or third round of funding comes. And so this does not generally come at the time of incorporation of the entity at all. This does not apply at that level.
Okay. If they go for crowdfunding after the incorporation, means what are the points they have to consider?
So see, when it comes to crowdfunding, here angel investors, they like in the slides that have been pointed out earlier, right? Crowdfunding, when it comes to, you will have a lot of shareholders who are coming into the picture, right? So crowdfunding is when you have some quite handful of people who come into the company and be investing in small amounts, and everybody becomes a shareholder in the company. Correct. So after the incorporation, correct, any funding that you go into, okay, angel investor is any funding that you go into, and any be the amount or anything, like Anand had pointed out earlier, when you do a valuation, a basic valuation by a merchant banker valuation, a free cash flow, discounted cash flow method, when they follow, a simple valuation is done. And based on the valuation and the investment comes through. The investment is either from one individual, from more than one individual, whether it's a crowdfunding or whatever it is, correct? Once the incorporation is done, once you go for the first round of funding, the section kicks in.
Okay.
But generally, that is not a very accepted or not a very see why it's not a very accepted method of investment is there is a lot of dilution that happens in the capital of the company. There's a lot of dilution that happens in the stake when you have a crowdfunding, and later when you go in for the second round of funding with big investors, with HNIs or with foreign investors or with companies with funds, when you go in for a second round of funding, right? That becomes a little bit of problem because you have a lot of shareholders at the initial level itself. You're already the management is diluted, the stakeholding is diluted, and it's small parts. It's with varied people. So generally, it's not a preferred method. It's generally not a very preferred method here to go in for a crowdfunding.
Now, it is also worthwhile understanding that since this being a corporate form of structure, there are certain restrictions when it results in terms of funding receipt. So it's not like a listed company where you ideally go ahead and start funding left, right, center with any number of investors. So there is a restriction that applies when it comes from a private, closely held company standpoint. So that needs to be looked into. But from an income tax standpoint, yes, there is always the liability or exposure from an angel tax standpoint. They are not bothered about who is funding, because when I talk about AIF, it's not an individual who's funding it. It's not a HNI who's funding it. So likewise, if it is going to be from any sort of government agencies from any country that is notified, that again becomes a mass funding by itself because it is a representative funding of the government. So in that case, we once again see that there is no point in identifying who funds it. If that funding is an exempted funding under the provisions of the tax law, then you don't have any restrictions. But if it is going to be one that is going to not be covered under any exemptions, you are exposing yourself into tax implications.
But we would
Okay,
generally not recommend a crowdfunding at all when once
Correct.
you started a private limited and when you decide to.
So because in private limited, we have the restrictions for the shareholders, right? Or I think
Correct.
200 members.
That is
Correct.
also
200
there,
is the
and also
maximum.
dilution of capital becomes on a higher side when you go in for a crowdfunding.
Okay. Ma'am, if we are raising crowdfunding as a grant, other than the providing the stakes of the company, some of the persons are raising it as a grant in the crowdfunding. Which is this also a taxable thing, or it has any exemption for that?
Okay, from a grant standpoint, what is the nature of grant? Because when we talk about grants, see, there are either revenue grants or capital grants. Now, if this is going to be in the form of a revenue grant, then we will have to see what is the purpose for which it is raised. Now, here you claim that it is an interest-free funding that you receive, or probably funding received in the form of a grant. Now,
Yes.
if it is going to be associated with any sort of an instrument, even though it might be the case of a grant for the purpose of form, in substance, it will become a contribution. So it will once again expose itself to tax. Now, if the grant is going to be by means of providing interest-free loans or by means of providing some machinery or something at free of cost, then that has to be taken up separately in terms of how the taxability will arise.
Okay.
There is a definition in the case of movable assets, which if acquired would constitute gift and therefore will be taxed under other sources. Or if there is going to be a grant, the grant has to be taxed if it is for the purpose of the business or profession. So there are other aspects which we have to be done.
Understood. Participants, any other questions?
I
Sir,
think there
there
are
is
a couple of
question.
questions. Yeah, 1 minute. So someone by name of Ajit or Plax and Plaskar have asked a couple of questions. So exemption only against equity shares, profit applicable for debenture fixed returns. Okay. Now there is no question of exemption that we've spoken about. Exemption is for the angel tax applicability itself. Now, when it comes to debentures, there is no specific rule that is mentioned. That's what I started off telling. So there is no specific rule that is mentioned. And therefore, what would happen? Whatever is the commonly traded price which it would fetch in the market will be considered as fair market value, and you will not be taxed beyond that, because companies also would not want to flush in more money because it also results in interest burden. Therefore, generally, they would restrict it and keep the fair market value as low as possible, because interest is going to be based on that particular option. And if the point is going to be no, I will have a face value on which the interest is to be paid, and then there is a premium which is received, etc. Still, the fair market value will seal for both put together. Therefore, there is no question of taxability. Now, when it comes to returns, whatever is going to be the interest that I'm going to pay to the debenture holders, that will be allowed as a tax deductible expenditure because it is for the purpose of business or profession. Now, is there any eligibility criteria for angel investors, like they should have minimum or maximum net worth? Nothing of that sort. So as long as the investors are being accepted by the company, what they really are will not really matter. And however, the companies themselves are in need, so they will generally not be in acceptance of small investors putting in 10 shares or 50 shares. So that is going to be in the form of huge investments. So the law as such does not restrict anyone to be a small investor, large investor, etc. But general presumption is that HNI is only the one who's going to put in money, or probably a consortium of companies are going to put in money. That is just the common sense of things that happens. Likewise, startup eligibility is valuation limit that I have already told you. So the startup eligibility is up to 10 years from the date of incorporation, and turnover should be within 100 crores, and you should have employment generation and wealth creation opportunities. You should also have a new idea or probably build to an existing idea, and then you will be considered as an eligible startup. Now, overall investment limitations, sorry, 1 second. Overall investment limitation per investor as well, number of investor limit, nothing of that sort. Now, number of investor limitation is more of a Companies Act standpoint, where the maximum number of members ceiling is being placed by the law in place. So you have to abide by the law. Just because there is a funding that comes into play, you cannot go ahead and start funding left, right, center. If you are going to fund more, and if you are within the brackets of tax law, it is also important to note that whether we are within the ambit of companies law as well, which is the guiding governing law body for that particular entity. Tax exemption percentage. There is no question of percentage here. The law itself will not be applicable. That is the exemption we are talking about. So unlike any specific exemptions where percentages are given, here the law itself will not be applicable. And against capital gains, there are no capital gains here. It is issue that is being made. So there is no question of capital gains here. There is only a capital raise that is happening. You are raising capital by issuing shares. So there is no capital gains here. Now, if this capital gains is questioned by means of subsequent sale by the investor, there is a separate set of provision. Now, likewise, there has to be a fair market valuation done for the share at the time of sale. And if you sell less than the fair market value, your fair market value will be deemed and taxed. That is a separate subject matter altogether, but that is more of an investor perspective, not from a startup perspective.
There is another question.
Yeah, please take it up, Samantha.
No, there was another question. I think in private limited shares are issued at, I think that's the next question. I'm not seeing anything other than that. Any other questions that we have, or in between? No, I think, yeah, the next question.
So the next question is, in private limited shares are issued at premium and investment is sealed. How is it done in LLP legally? Okay, so the LLP here is more of a capital contribution that happens. And as long as you have this capital contribution ability, you generally can go ahead with it. But now the point that we have to note is, LLP being a body is registered under the provisions of the Startup Act, where the startups are concerned, eligible startups are concerned, LLP is accepted. But the discussion point that we are having right now is with shares, and angel tax coincidentally collides with it, because private unlisted company or closely held companies are the ones we are talking about from a tax standpoint, because that is where the funding is going to come into the form of shares, which has a fair market value, which will be debated upon. Now, for defining what is an eligible startup, they had given the definition of LLP, etc. That's it. So it should not be interlinked with one another. LLP taxation is a separate subject matter altogether, so that can be taken up separately. So there is no mandate that it has to be valued in such a fashion and taxed in such a fashion. And there are separate rules when it comes to the matter of LLP, where the valuation of security needs to be done for the purpose of funding to be raised. And there you don't have this
only on equity shares.
Infusion
does not come, LLP picture does not come into this aspect.
Okay, I hope the question also stands answered with both of them. So yes, so that's about it.
There is no, yes, sir. Participants, any other questions?
Good afternoon, sir. It's Balaji from VP Forum Control. Thanks for the wonderful session, ma'am. Samyukta ma'am and the wonderful session. So can I get the PPT for your session? It would be great to share with our startups.
Sure. We'll do that.
How can I get that? Can I send our email to the chat? Can you share it?
We will send it to the coordinator here, and I think you can get it from him directly.
Yeah,
He'll be able to share it with you.
I will share the mail ID to them.
Thank you.
So you can mail to us, we will share forward the PPT.
Yeah, I will.
Yeah,
we will
sure.
share it.
Thanks for sharing.
Any other questions? I think there is no questions now. So thank you for your wonderful time, sir. It's a full packed knowledge session. I didn't expect this much things from you, and we have done some of the technical glitches in the beginning, but you have patiently waited for us. Thank you so much, both of you. Thank you, Samyukta ma'am. Thank you, Anandaraman sir, for your wonderful session.
Yeah, you're welcome. Thank you. Thank you all.
Thank you, everyone.